Hello everyone, today we'll compare yield farming to staking to find the best possible investment solution for you. I will take account important metrics like investment duration, risk tolerance and budget. But before we're getting started, this is not financial advice. I'm not a financial advisor and this video is meant to be for educational purposes only. Always do your own research. But now, let's get started. First, what is yield farming? Well, yield farming can be done in a variety of ways. But the most traditional one and the most commonly practiced one is providing liquidity to decentralized finance protocols. This is typically done through lending or staking cryptocurrency assets. By doing so, yield farmers receive rewards, which are paid in additional cryptocurrencies or a share of the generated fees. On the other side, staking requires its users to lock up their funds for a certain period of time. The goal is to secure the network. Stakers also receive rewards, which are paid in the native cryptocurrency that they're staking. Now, let's look at the differences between the operations in yield farming and staking. Well, in yield farming, yield farmers basically act as the banks for decentralized finance protocols. This means that they're lending cryptocurrency assets and receive interest on the assets they're lending, which traditionally fulfills the role of a bank, as banks traditionally lend money to people and of course receive interest on the money they're lending. In yield farming, the process is often done through so-called dApps, or decentralized applications, which involves wallets, and decentralized exchanges, where users stake their cryptocurrency coins. As a general rule of thumb, the higher the volatility, the higher the return on invest will be. But it's not as simple as that. There are also a couple of other factors that determine the return on invest. Those can be the loan duration, the cryptocurrency in itself, and of course the volatility. Now you may ask yourself, but why do crypto exchanges offer yield farming and why do they pay interest? Well, let's look at the process. In yield farming, first the decentralized exchange receives additional funds. Those additional funds can be used, for example, to boost the liquidity of the exchange and of course also the transaction volume. This increase attracts more investors as it becomes more and more easier to buy and sell cryptocurrency assets. The hope of the exchange is that those traders then stay on the platform and buy and sell more and more cryptocurrencies over time, which generates additional fees. Well, on the other side, staking requires its users, like I mentioned earlier, to lock up their funds for a certain period of time. So there is a so-called lockup period. The lockup period is necessary to secure the network. The staking process can typically be done very simply by just using a wallet. It's very straightforward. But it's also possible to participate in a so-called staking pool. A staking pool is a network of people staking the same cryptocurrency. They combine their staking power to generate higher rewards. Those higher rewards are then distributed among the network, all depending, of course, on the position that everybody's holding. Well, there's not only that. In staking, there's also another important role that is often forgotten about, and those are the so-called validators. Validators are responsible for proposing new blocks, and they're not only responsible for proposing new blocks, they're also responsible for validating transactions, which is the heart of all of crypto. And those validators also, they stake a certain amount of cryptocurrency and they use their own cryptocurrency as a collateral for the exchange. But now, let's look at the advantages and disadvantages of yield farming and staking to get a better picture of what investment is better for who. Yield farming has a couple of advantages. By one, it has a high flexibility. A high flexibility means there is no lockup period like there is in staking. You don't have to wait a certain time before you can move your cryptocurrencies. It's always possible to move cryptocurrencies. This is great because you can also cash out on returns quicker, and you can adapt your strategy in the times of market volatility. Also, it's possible to make huge returns. The return on invest is typically significantly higher than in staking. This is the case because the decentralized exchanges, their aim is to get more and more investors to invest in their platform and keep them for the long term. And also for the smaller coins they're holding on those exchanges. It's important to gain new investors to boost the liquidity, which makes it, of course, easier to buy and sell cryptocurrency assets. But there's also a negative side on this. While there are high returns, it doesn't often not mean that those investors receive the high returns. The high returns are often very promising, but it can be the case, for example, that those decentralized exchanges are scams, or even if they're not scams, they're not able to pay out the return on invest they're promising. Or even in worst case scenarios, you can suffer an impermanent loss. An impermanent loss means that you lose all of your cryptocurrencies, let it be from a scam or because the cryptocurrency exchange simply has not the liquidity to pay out investors. On the other side, staking also has benefits but also drawbacks. Well, some of the benefits are, for example, that it's pretty easy to set up. The process is straightforward and it does not require, like in yield farming, active management. So it's possible to lock up the cryptocurrencies for a certain period of time and then perform actions like withdrawing them after another certain period of time. Also, it's a lot more predictable, the outcome, as staking is typically done on already established exchanges, and the returns are not promised as crazy, so the outcome can be seen as more realistic, as the outcome can be received more realistic for the revenue that is gained by the investors. On the other side, it also brings a couple of deficits. Obviously, the risk is not as high as for yield farming, but this does not mean there is no risk. There is still a high risk, but this is not all. The main problem is that the flexibility can be very low, and this can be a problem, for example, if the cryptocurrency is very volatile. If it's very volatile and you're not able to perform any actions, you cannot adapt your strategy, you cannot sell or buy more cryptocurrencies. You have to wait at least until the time has passed, until you're able to make more transactions. Now, let's look what is better for who. Well, what is better for who typically depends on the person in itself. But there are a couple of trends that are very important. For example, usually for higher returns with small cap, yield farming is a lot better, as there are huge returns possible. And with smaller sums of money, investors are typically likely to take higher risks, as even if the money is lost, there's not a huge impact on their overall portfolio loss. On the other side, for people who have already a lot of money, who have more money, they're typically tending to go towards staking, as it's a lot more predictable and it's a lot more easier and comfortable to do, as there is no active management needed. And of course, it's also very easy, the process. You just need a wallet or you participate in a staking pool, but there is no active management needed. On the other side, those people who don't have a lot of money or who are just very risk averse, who are okay with taking losses and downfalls, or people who are good who have a higher technical expertise, they're typically tending to go more towards yield farming, as again the returns are much higher, and of course the flexibility is also a lot higher, as those people, they can manage and adapt strategies very quick, which of course can be an asset if you have a high technical expertise and you're very risk averse with financial decision making. So all in all, people who have a lot of money and are conservative tend to go towards staking, as it's a lot more predictable and safer. On the other side, there are also people who can go to staking who don't have a lot of money, but they want predictability. But those people who are looking for high returns on invest, let it be for short term or can even be long term, are typically tend to go towards yield farming, as the returns are a lot higher, and of course the flexibility makes it a lot more easier for them to manage funds and realize profits. I will show you how to get started with both yield farming and staking, so you can start your process right now.
There are many different exchanges where it's possible to do yield farming. In this example, I will use SushiSwap. To start the process on SushiSwap, go to sushi.com. Once you're on sushi.com, click on Pools. Once you clicked on Pools, you can see the different pools that are possible. For example, in here, you see Bitcoin and Ethereum. You can see that there's a TVL, which means total value locked. TVL implies the amount of value that is locked in a certain system, in this case in the pool. Generally, the higher the number, the better, as a higher number implies a higher volume, and a higher volume typically indicates a higher liquidity, which can be very important when withdrawing your crypto assets, as it's typically easier. Also, you can see the volume. Typically, a higher volume can be seen as good or bad, as it can imply a high volatility, but also it can decrease stabilization if the volume is too high. Also, on the right you can see the so-called APR, which means an annual percentage return. This is the return you receive on top of lending your assets for 1 year, in terms of a percentage that you get on top. So after you picked one, for example, let's pick this one, we will be directed to this site. To add liquidity, you first need to connect your wallet. I already connected my wallet, but you can do it on the top. And besides your wallet, you can also select the network that you want to do it. I already did it, but it's really easy to do. Then it's time to add liquidity. Once you connected your wallet, and in my case I connected with the MetaMask wallet, it shows the possible liquidity that you can add. In this case I have to add both Ethereum and USDT. So I will add this, and then you have to approve the USDT. You get to your MetaMask wallet. Next you have to approve. Then you have to approve the USDT here. To approve the USDT, they will connect you to your wallet. You have to approve your wallet. Also, you can customize your spending cap. In my case, I will just do max. After you do this, you can also view the details here, but I'm just gonna click next. Then I have to approve. And after approving, I can view the whole transaction on the blockchain. On the other side, there are also a lot of different ways to do the staking process. The platform I use so far a lot is the Kraken exchange platform, which is also very easy to do and very easy to use. To get starting with the staking on the Kraken exchange, you first have to create an account, or if you already have an account, you just log into your account. Once you're logged in, you click on the top and you can select Kraken Pro. Once you selected Kraken Pro, you will be transferred to the Kraken Pro website. Once you're there, you can see already I have the trade of Bitcoin USD open, which might not be the case for you, but it doesn't matter. as you always have to click on earn first. And after you clicked on earn, you see the different cryptocurrencies that you can stake. And those are the estimated initial percentage returns, which you can make for each of those cryptos. Of course, the more volatile a crypto asset is, the higher the APR will be, of course. As you see, I already have some Bitcoin, so I will select Bitcoin. Here you can see the amount that is possible for you to stake. In my case, I will select max. Also, when you scroll down, you can see what type of rewards you receive and how often do you receive. Make sure you are aware of this before you start. So in my case, I'm just going to click allocate now. And this is already done. I already did the staking, so it's really that simple.
So finally, what have you learned? First, you learned the differences between yield farming and staking. You learned that there are a couple of major differences. For example, that yield farming is a bit more complex and you basically act as a digital bank as you lend money and you receive assets and additional assets on the money you're lending. But you also learned that yield farming is a lot more risky, but can pay off much higher returns. On the other side, you learned that staking is more conservative. It's also a lot more easier, but it requires you to lock up your funds for a certain period of time. Also, finally, you learned that staking is more for conservative investors. As like I mentioned, it's a lot easier to manage and it provides more stability. On the other side, yield farming is more for investors who seek higher risk and want higher returns. So, what do you like more? Are you more on the conservative or more on the risky side? Let me know. I will see you in the next video.